can catch up through that. If you've got any questions, feel free to chat using the chat function in Zoom. In terms of the agenda, what we're going to go through is just to sort of discuss, as per the poll that's up at the moment, what is the profit you're trying to measure, because that will change the methodology. From the broad spectrum of clients that we have, there's quite an array of methodologies being used in UniPhi to measure profits. So that's the first question you really need to ask yourself when looking at the basic out-of-the-box reports in profitability, and also perhaps how you're setting things up in Power BI if those reports aren't giving you what you need. So that'll be a fair bit to that particular discussion. The second part of the session will be if you're using a rates-based methodology, how can you establish rates in UniPhi, and some of the questions around using rates as a method. So what I mean there is you've got people timesheeting and you're multiplying that by a rate to determine the resource cost on a project. And so we'll cover that off halfway through the webinar. And then lastly, if you're not doing that, you may be doing a chart of accounts method where you have project ledgers in your accounting system, or you're using UniPhi as the project ledger, and you have internal revenue and internal cost codes that you're coding cost to and revenue to, and obviously one minus the other, giving us a profit. So we're going to look at that methodology as well at the end. But first we need to sort of have a pretty decent chat about what profit are you measuring. And the first one I alluded to there is using a rates-based method versus a chart of accounts-based method, which obviously your accounting system would have for corporate profitability, but it may not have the project ledger capability to tell you how a project's performed. And then obviously if you're using a rates-based methodology, you're using a standard costing model, and that will be different to your corporate profitability. And how are you going to handle that, and what are you going to do about that is of interest. And there's a few things you can do that may be of interest around that using UniPhi. Then within sort of project profitability, which is typically what UniPhi is used for, are we looking at a whole of project profitability or a financial year? And obviously there's two different data sets in that particular equation, which I'm going to go through. And then are you looking at it from a project by project perspective, or are you looking at it from a portfolio aggregate perspective as well? If you are using the rates-based methodology, how do you compare standard versus actual? What's available? Are you measuring down to a gross margin, or are you trying to get to a net margin on your projects? We'll discuss that. What's the difference? And then, you know, forecast versus actual, analyzing the differences between those two. And then, you know, what are the methods within UniPhi to look at net sales revenue, gross margin, and net margin as well. So they're all different measures of profitability. Which ones are you using? What methodology are you going about calculating those, and how can UniPhi support that? So that's the first element. So to help me explain those bits, what I'm going to do is just get out of that presentation for a minute and go into UniPhi. So if I just go to the summary first, this is a practice management deployment presentation system with dummy data. We're in the portfolio summary, and I'm just going to click on the hamburger and go to the reports and just have a look at some of the out-of-the-box reports that come with UniPhi. And once you go into reports, there's a sub-nav called Profitability. And within that report list, one of the ones that's both project and portfolio based is the one called Project Analysis. So I'm just going to run that. And I'm just going to use the default filters that have come up there and click View and see what comes up. And so what this has given us is a portfolio list of projects that have actual revenue or forecast revenue, actual revenue, forecast cost in the relevant time period that I've selected, which in this instance is 1st of July 2019 through to the 31st of March 2021. So a bit of a weird time period, but that gives me some good data in this database. And so project by project, going down the screen, it's got a whole bunch of information that includes profit. As we go through each of these columns, you can see that there's a column called agreed revenue, and one called a final forecast revenue. And so this links back to the question, are you looking at total forecasted profitability or within a time period of a financial year? We then have invoice to date being up to that particular March 2021, a forecast cost at completion, actual cost to date, percentage complete, which is one divided by the other. So actual cost divided by forecast cost gives you a percentage complete. You can see 85% is 1050 divided by 1236. And then that figure there is used to give you a revenue earned to date. And so that's multiplying the 85% in this particular instance by the final forecast fee, which you can see is different to the agreed revenue, which I'm going to explain in a minute. And the difference between what you've invoiced, which in this instance is 1.2 million, and this 1.89 is giving you a WIP figure there saying that you've got $691,000 potentially. Then we've got some profit percentages, and the first one is on actuals to date. So we're looking at the invoiced value versus the cost. So 1.2 versus 1050 gives us a 12% margin. And then we're looking at completion. So because of that big WIP, our at completion goes up quite a lot. So that's looking at the 2.25 million final forecast revenue versus the 1.236 final cost. So this particular project's saying we've only got $36,000 worth of cost to go, and we're going to get another $1 million of revenue out of it. And that's what those margins are giving you here. But similar to that list of questions that I had, we've got in here invoiced in the period, actual in the period, which gives you a profit in the period. And so you can look at that being the period that you've stated up in this start and end date here, which could be a monthly thing. It typically is with our clients. So you're looking at monthly profitability in this section here with the dotted lines. This is less about profitability and more about sort of sales growth, this one, so we'll ignore that for now. And so just within this one sort of report, you can see that there's lots of different profits that you can measure. Now, some of the interesting things about where these values come from, let's just look at this Universal Studios project and have a look at each column. If I go back into the deployment and I go to the summary screen again, first I'm going to try and find Universal, and it doesn't appear there. And the reason is it's actually a closed project. And so in this report, what you'll see is I've selected all phases so that we get all of the activity that occurs within that period. Sometimes you'll also get all active, which it would show as well. That means anything that has something that is active within this financial period here. So I've selected all active there. These projects would be disappeared from the portfolio view. I wouldn't get my Universal Studios. So that means I need to go all phases here to see what I'm talking about. So in the filtering here, I can go all phases, and that updates my project list with every single project that's ever existed in this deployment now. And I can search for Universal Studios and select it. When I go to the contracts module, you'll see that under the revenue filter, there are two contracts. And if I drill in on one of them, scroll down, you'll see that this particular contract has an agreed revenue of 1.2 because this 15,200 was added in after the contract was signed. So some of these columns won't appear in your particular deployment because you may not have set up the processes and the rigor that is going to generate their values. So in this particular instance, the way that agreed revenue figure gets into the system is that you are signing off contracts within UniPhi. And when you sign off a contract through the documents module, that snapshots that particular value as it was in that point in time. That way people can still change these values here if you like, but we still know what the agreed revenue was in the contract, the one we've got evidence of where there's actually a signed document. And UniPhi also files that in a nice neat place for us. If we go to the details section of the contract, you'll see that contract will always be displayed here, which I can launch and then see the executed document and its value in the system. And therefore I've always got a quick access to where my evidence is for where that value has come from, this 1.2. And so that's why in that report, we've got a slightly different final forecast fee to agreed revenue, is that those numbers are slightly different between what was signed off. There's the 1215 there versus the 12, and if I went into the other contract, it'd show the differences there as well. So the final forecast revenue is a whole of project contracted fee. And so plus any other elements that you may put into the system through the forecast to complete function in the revenue module. So any pending variations, any Possible variations, any changed contract amounts will appear here as a sum up total. Invoice to date is what you've progressed against that. So you can see here, we've got a total claimed of 1.1 million on this particular contract. That's coming in to that $1.1 million there on that particular project. There's 2 projects within the overall parent of Universal Studios. The forecast cost of completion starts to get interesting. So the first element of these particular costs will come from the timesheet system. So you can see here, it's the actual cost here of 842. It's coming from the timesheet system times rates, and we're going to get to that in detail later. If you don't have, it also comes from the internal cost chart of accounts, which you're going to get to later too. So you can do a chart of accounts method only, or a rates method only, or a combination of the 2, which is typically what's done. You'll have like your pass-through disbursements, maybe sub-consultants or travel and other disbursements in an internal cost chart of accounts. And then you'll have your resource costs coming in from rates that have been built up against a person. And then when they timesheet, that timesheet multiplied by the rate gives you this actual cost. The forecast cost of completion comes from either a forecast that you've put in to the phasing, the manual month-by-month phasing of the internal costs, maybe consultant fees again, or travel, plus any resource hours you've estimated to complete the job in the resource planning module. So if you put into the resource planning module some forecast hours, they'll be added to the cost of the project on top of the timesheet hours that have been put in by the individuals when they do their timesheets. And so those 2 numbers are calculated by a combination of cost codes and timesheet/resource planning hours. And so the hours and the dollar values are coming from multiple sources within UniPhi, and that needs to be sort of aware of. Once you've got all of these columns being populated with data from those data entry points, everything else from here on in is a calculation. And so it's just basic maths on those columns. Those calculations are detailed in detail from a financial management manual off our website that you can look into after this session. And so, from this particular report, that's the methodology that's being used, is a combined chart of accounts plus hours methodology for calculating. The time period for calculating that is whole of project. The only period based is an end date for this actual cost to date and invoice to date. The end date is coming from the end date that you've selected in the filter. The start date is only used on these columns here for the invoiced and actual costs in the period calculations. This is always from inception until the end date that you've selected here, where the relevant to date field exists. If it's at completion or final forecast revenue, it's a whole of project. And what that means is you don't actually need any month by month calculation for it. It's actually what you've entered into the contract system for final forecast revenue. This contrasts to some of the other profit report that comes in out of the box. So if I go back into the reporting section and select profitability, and if I was to select project profitability, one of the things that's interesting about the filters here is that we don't have a date range, we just have a financial period. And you select the financial period that you want to report actuals up to, and then you decide whether you're trying to report a whole of project at completion report, or whether you're trying to do a financial year. And so this is important for determining where the data is going to come from. So when I select whole of project, what it will do is it will show actuals for a month that you've selected here, being March, actuals from project inception up to that date. So from, say, it started on the 2018 through to March 2019 would be shown here. And then at completion, no longer worries about a month by month. It just looks at the revenue that's in the contract system for an estimate at completion versus a whole of budget estimate. You can see here, so that's that. I'll come back to financial year in a moment. I'll just look at this report. You can see here that it's split the revenue up into 2 elements, because you may have pending and possible variations. So they'll be displayed in here. And if I click the plus, it actually splits those into the coding that is in the cost code, or revenue code, sorry, structure. So committed is when you've got actually an agreed contract with someone. When you've got possible and pending, it comes into these potential fees, and then they all sum up to get a gross revenue total. And then what it does is it uses the internal cost charts of accounts to work out a disbursement. And so in here, you'll see that there's some costs coming out of this in the budget, but there's no, we now no longer think we're going to need to outsource that particular cost. That creates a net sales revenue calculation where you're subtracting from gross revenue any pass-through costs. And that improves the margin calculation because you're no longer distorting the overall revenue by some pass-through if you've got a large subconsultant on the costs that you're not making a markup on. Then what it does is it says, okay, that's my chart of accounts related costs. Then I have my resource-based costs where we're using timesheets and resource planning times rates. And so when people timesheeting or when we've put resource hours against these people here, we're multiplying that by their rates to get an estimate at completion or to get a project to date cost and an actual cost. And so what that means is that if you're doing kind of a bit of both and your chart of accounts has resource costs in it, there's a chance that you could double up just using this report, and you're going to need to amend the report to have a different methodology, which we can do for you, or develop some Power BI dashboards to do that for you. And so out of the box, we assume most target clients of ours using this type of profitability are using a mix of rates from the timesheet system plus pass-through costs. If your system's not, your business isn't doing that, then some of these reports are not going to necessarily report what you want. Then from there, what we get from net sales revenue is it says net profit here, but it really just depends on how you've calculated your rates, which, as I said, I'll get to in the rates section and the rates build up. But a net profit and a net margin on that profit is displayed for you, both for the month period, project to date, and as well at completion. If I was to change that to a financial year, what that means is that it'll only look at costs that are incurred in the 2019-2020 financial year. And so when I click view here, the at completion changes to a phased-based methodology. And you can see that there's no forecasted revenue in the financial year, and there's no budget. There is a budget in the financial year. So that means that the numbers have to have come from a month-by-month data entry point. Resource allocated costs tend to be entered in by the month, so they've got those costs there. To get that revenue in, what you would need to do is in the revenue module, you would need to have put into the bag end project some phasing in the relevant time period for that chart of accounts, for that to then flow through into the report. So there's no forecast for that time period. There is a budget, and hence that's why a little bit of budget came in for that particular period. If I jumped the financial year ahead to be in the next financial year, you saw there were some numbers there. So I'll just go August, for example. We'll get a bigger forecast and a bigger budget here because it's now looking at that 12-month window. And even some actuals have come into that financial year. So depending on the filter that you selected here, that will quite dramatically change what's coming into these particular columns. And something worth considering.
Sorry, the cost with the resource allocated cost, does that pull up everybody's, the work, people who've done the work and their times or their cost, their hours worked?
So if you see here with Annie, Howard, Peter and Sean, they haven't actually done any timesheets yet, but we did expect them to. And so you'll see that there's a budget that they did. That comes from the resource planning section. Actuals come from the timesheet section. And so if I go back into this project again and I go to resources and resource planning, you can see that Annie and Sean have some hours allocated to them. That's why they've got some, and that's in the actual forecasts area. At the moment, this would represent just forecast. It'll be grayed out if it's actuals. It's there to show you that there are some. So if I scroll back through time, you can see these are grayed out because the timesheets have been submitted for that period. And then if I flick to budget, I'll then see that there's budgeted hours against them as well. And so those resource allocated costs in that particular report, that's how they're getting calculated.
Okay, beautiful. Thank you.
Okay, and then the last quick one I wanted to show is if you then go and look at, in the profitability, a portfolio report that aggregates everything. And so this is looking at all of the entire portfolio of projects. It'll always be a financial year unless you're doing project by project analysis. When you're aggregating into sectors, it'll look at it from a financial year perspective, because the timelines are so dramatically different. It's hard to line up on it if you're aggregating across the portfolio, but it's exactly the same report as the project profitability. So that would represent a way for you to see how much all of your resources have cost you in a financial year, both within a month and the financial year to date and at the financial year end. And you can then sense check that data with their salaries and on costs and what you're expecting to come through, to start doing variance analysis between standard cost and actual cost, which is basically my segue into the rates conversation. The fundamental debate ever since we've deployed UniPhi, and I'm sure it's going longer than that, it's not actually a UniPhi issue, is how do you build up your rates, and do people timesheet a standard 40-hour or 37.5-hour week, or do they timesheet their actual hours, so they've actually worked, which may be substantially greater than that or less perhaps. And that's something for people to internally debate. We have opinions that don't matter on that particular thing. That's for each company to work out, but they will have an impact on these particular portfolio reports. Obviously, if you've got a rate build up that you've based off 40 hours and people are timesheeting 60, then that project profitability is probably accurate, but the portfolio profitability will be showing a higher cost because it'll be using those 60 hours times the rate. And that's an example of where you can get quite large numbers in here, like 244,000 for Christopher Lee. He might be only on, expected to be 180, and it's because he's doing a lot of time on the projects that he's working on. So that's something to be worked through. And within that debate, UniPhi gives you some sort of options around helping, supporting whichever methodology you go. If you go with a timesheet your actual hours and you know what the standard are, you can start to analyze whether the costs are greater because people are doing more work, or because potentially your rate buildup is too low or too high. And to give an example of that, what I've got is a little spreadsheet basically to look at a rate buildup. Now, I'll show you in a minute where this data can go. You can build up your rates outside of UniPhi, or you can actually get the rates to be built up within UniPhi. It's up to you. Once you've built up the rate outside of UniPhi, you can then just key that rate in against a person, or you can put it against a classification, or you can even, as I said, get UniPhi to calculate this methodology that's in here. And so looking at this methodology, let's say we've got a classification. This could be, cadet, or I always get in trouble putting in salaries. I get yelled down as to what they should be, but 70,000 is a pretty good cadet salary, but let's say that's it. Then you need to say, okay, this is full-time. How many hours is full-time in the year? And so that's entirely up to you what that is. In this particular one, we've done 40 times 42, so 40 hours a week for 42 weeks in the year. That gives us a raw rate, raw being just their salary being considered, of $42. You can see that division there, rounded to the whole dollar. And then we know about some direct on costs that we can increase that rate by, and we've just put them in, and you can put as many as you know about into there and increase your rate. And that builds it up to 49. And then you have a decision to make. And this is why I mentioned, are you measuring to gross margin or to net margin? And we're not, our opinion in this is you'd probably stop there, because allocating overhead to projects is something that a project manager on that project can't really control. If management has Rolls-Royce facilities and does a lot of marketing because they're trying to build sales, it's not really a project decision, it's a corporate decision. Overheads go up, their project gets hit with a higher cost, but they haven't really managed that. But that's up to you. You would just change the target to a gross margin target rather than a net margin target when looking at their performance. But if you did want a net margin target, you would need to allocate an overhead. And so in this instance, we've just chucked in 20%, and that's been increased on the 49, so you've got 59. So that's up to you. That's how you can build that up. Now, there's going to be obviously some issues when looking at that from a timesheet perspective, because of the 40 hours and because the overhead allocation may be out a bit. You may, workers' comp may come in higher, who knows. And so there could be some rate-related differences and some volume-related differences through the number of hours timesheeted. All of those things can be actually calculated in Power BI and presented to management as a variance on the costs from a portfolio perspective, from a corporate profitability being generated out of your accounting system versus a UniPhi profitability being generated by standard rates. However, if you wanted to do that, you would need to capture this data. And so I just thought it'd be worthwhile in this webinar to show you where that information gets captured. And so what you would need to do is to go into the configuration in UniPhi and go to resources. I'm going to rename some of these things, but this is how it works at the moment. Now, if you used Excel, you could type in that $59 rate directly against the cadet quantity surveyor over here and say, okay, they're costing me $59. There'd be no evidence of where that came from in UniPhi, it'd just be a rate. And then you can apply that, as I'll show you in a moment, to people, and it'll use that $59 for their hourly rate when working out costs. Alternatively, what you can do is you can go to employment types and create different full-times or a casual or 50% part-time. And basically what that does is it changes the salary hours here. Now, a casual isn't on salary at all, so you just put 1 in there because they're just going to have an hourly rate. Whereas part-time, you've halved the hours here, and the different full-time numbers, you've changed the salary hours here. So that sets the denominator for the rate, for the raw rate calculation. Then in the rate multipliers, what you can do is you can do some funky stuff. Most of it's probably overblown around the starting people on a base hourly rate plus their salary. That doesn't happen very often, but that's what that is. So this would be $70 plus their salary divided by the raw rate. Or you use that when you're doing casual and they're only going to have an hourly rate. So you can see here that that will be casual people allocated on $70 an hour. And you could label casual as many different things as you like, for different levels. Then you can multiply that both for charge and cost by any markups that you want to apply. Now in here for these quantity surveyor cadets and QS, this is allowing for the super payroll workers comp increase plus the overhead allocation. So in our spreadsheet, that would be a 47, is that right? 37.5. So 1.375 would be the increase that we've used there. So in here, we would type the cost increase to be 1.375. And that will basically increase the raw calculation. So that's salary divided by hours by an increase for overhead and for on costs. And so once we've done that, what happens is when we go to the resources system and we look at someone, let's have a look at Annie Lennox here, they'll have a rate history. And the history is important because if people change their rates over time, we want long-running projects to use the rate that was relevant at the time that the timesheet was entered, and that way it won't be distorting the costs there. But added to that, what this demonstrates is the demonstration of how the rates can get calculated. So you can see we've got this classification drop down. That's the one where we just type the $59 in. Alternatively, you can use the automatic calculation based on their multiplier and their employment type. And so the junior QS multiplier, I could change that to cadet QS. That was 1.375. I then pick which employment type. Let's just say full time. That sets the hours for the salary. This is Annie's salary. And then the cost rate will be calculated from there. So if I hit save, because I changed it to cadet QS, you can see that the rate now changed in there. Alternatively, I could set it just to be that classification. So if I go per classification and hit save, it changes it to whatever that quantity surveyor classification is. And so now you can see it changed to 50. So you can have a mix across your resource profile of using those two methods. Per classification is just whatever you've typed in for that classification. Automatic means use the salary divided by hours multiplied by the multiplier. And manual just means that per person, you're going to key in the rate yourself. So if I change that to manual, I can now key in the rate myself manually per person rather than using a standard classification. And so you have that at your disposal. If you get the automatic classification in Power BI, you can start to look at those underlying methods and look at, okay, we expected 1,800 hours, they booked 1,900, do 100 hours times that rate, and that gives you how much of a cost variance caused by standard rate variances, volume variances, sorry. And that sort of analysis can be done using the data captured in the system. Any questions on that? All good? Okay, so they're the main ways to capture the rates that drive into the resource allocated cost calculations in this particular system. We have other clients who want to get an actual rate in the system so that when they sum it up, it's going to be correct. And they'll use a methodology that uses that total number of hours, 1800. Say your timesheet 40 hours in the week to a project, you get 40 divided by 1800 for the year, multiplied by their salary is allocated to your project. And so they're using it as a proportion of the standard hours multiplied by the salary, so that they always get the salary cost in there for resource cost on a project, not any inflated cost based on an excess of hours. So that's another methodology you can use. If you're going to use that and you wanted standard reports to be run out of the system, you'd need to contact us. Otherwise, you can start to use the Power BI interfaces to start to build that up, and you have the ability here. You can see all of these measures that you can use. This is a manually calculated measure for you to determine what rates and methodologies you can put in to generate your costs in Power BI. That's much more complicated, but the point is the ability's there, and then you can start to get these project by project actual revenue resource cost calcs based on your methodology. There's so many ways of doing it. You wouldn't believe. We didn't think there would be when we started out either. But now you've got that capability to sort of start to derive that sort of thing. The final methodology that we're going to look at is the charts of accounts. And as I mentioned initially, so let's go back into the system for a moment. For most consultancies, this is where you've subcontracted or subconsult some of the work. So large projects might have some subcontractors costs that you're passing through. You might have travel and other costs that you're claiming back from the client, or directly allocating to the project and not claiming back, up to you, that you want to get captured against the project profitability. That's the main way that these are being used, but equally we have property developers, and we have subcontractors and contractors who are really not wanting to worry too much. Most of the cost in their project is purchased items, and they don't want to, the issue around resource time is small. They have small number of internal people on the project, large numbers of external people that they're paying through purchase orders and the like. And so that's where you want the resource rates thing to be pretty much moot, and you just want all of the costs to be coming from either your charts of accounts. So going into the configuration, the key to understanding either of those options is this classification here: internal cost and internal revenue versus project cost. In this instance, that's slightly wrong in this particular build, and I'll change it now. You'll see here we've got two charts here called fit out and fit out cost, and then we've got revenue consulting and internal costs. If we look at, say, revenue consulting and internal costs would be the ones you're using in that consultancy. Again, yeah, that's not the greatest list there, but you would have there the things that they could be your sub-consultant fees against those cost codes, and you can have also in there extra items for your travel and other things that you're claiming back from the client. Then it's just a question of whether that's the codes that are going into your accounting system, if you have accounting integration on, or if they have a subledger or not, and there's ways to work through all of those issues depending on what's happening. It becomes quite a simple thing after that. Once you've flagged internal cost and internal revenue, you can then run reports that do one minus the other, and that's pretty much all there needs to be. In that instance, most of it is done either looking at total contract values for those charts of accounts, or the phased month by month cash flows for those. And so the best example we have of that is if you run the cash flow reports rather than the profitability reports. And so in the cash flow, there's a cash flow by period. And if I just run that, you can see in the filtering up the top here, you have two charts of accounts to select. One is a revenue chart of accounts, and the other is a cost chart of accounts. And I've selected that internal cost, and I've selected the revenue consulting. And what that means is that the report will generate with two structures. This is all of your revenue coming in from the different services that you're providing, tracked over time. This is the internal costs coming in, tracked over time. They're negative numbers. The 10,000 minus the 509 gives us that particular net, which is a net profit in this instance, this report called a net cash flow. And so in this instance, there's no resource costs coming in, which is a bit of a challenge for the people who are doing that for their internal time. They need to either have project by project splits in their payroll system to come into their charts of accounts, or what some do is actually create dummy cost contracts for their staff and allocate costs to each project through those contracts, which is quite interesting. And that way the costs get allocated into the projects for the resource time. As I said, that tends to be a small component of the overall project cost, because their projects, there might be a $20 million construction project, and your project manager time is equal to $50,000 or $80,000 of that total cost. But for those who want to get all of that cost allocated, that's another method you can do. And that way the labor costs will come in as a coded line in here for the project. And you can see this is an aggregated one across all projects, but there's nothing stopping you looking at specific projects and having the same calculation done just for that particular project as a profit outcome. So yeah, and again, with another client we've got, actually, it's interesting. They have a timing difference between when costs get recognized via that methodology. For example, payroll's a monthly thing, and then it takes time for the allocations to come into the projects via their accounting system, and they want to be able to track during the month how they're performing. And so they actually have a flip between the resource rates and the cost codes. If cost codes exist for that month for labor, then use that cost, otherwise use the resource rates times hours. And so that was a complicated little customization they got to their reports. So they could run a report in the month and it'll tell them how much resource costs they've incurred for that particular project versus expected revenue, and not have to wait probably to the middle of the next month to find out if that project was actually running profit. There's one last thing worth demonstrating in the system is if you do get the traditional UniPhi traditional out-of-the-box methodology working for you, which is where you're using resource rates to track profitability, then this little internal indicator starts to kick in and is worth having in your portfolio dashboard. Where it's going yellow and red, the chances are that that's going to be for a profit reason. So I just clicked into that Adidas factory. If I go to the status, that wasn't a good example. Should have checked that before the session. My apologies. There we go. This particular project is running at a loss, or has a forecast loss of $29,150. That figure should match the at completion forecast for that. There's actually quite a long-winded algorithm determining all the different various profits there could be, like a financial loss in the financial year, a financial loss at completion, an actual loss to date, all those sorts of things. And they're the sorts of things that will then drive that to go red or yellow. It'll go yellow with intolerance of percentage margins. And so, yeah, if that's something you can get generated across your business, you can start to use that as a way of quickly seeing which projects are running not too well. So these are sortable data grids. So if I click on the little internal, that's like an internal indicator. It's what it's there. All of the reds are now at the top. And you would expect the non-billables to be red, so you could filter that out to say, give me just the client revenue related ones. We put them in as an option here instead of the internal corporate. And that way you're looking at the right projects to start to analyze and drill in on and see why the Citadel Heights Stage 1 project is project to date. So that one's looking at actuals, whereas the other one's looking at forecast. And that's it. So I've recorded all of that. I'll stop the recording now and happy to answer any other questions.